funds in money market accounts have topped 7.2 trillion. That's a boatload of cash on the sidelines, guys. Mm-hmm. It's not what it may seem, though. There are a few things driving this, and I think it's worth unpacking this meme for people who may be thinking that this is a...
Does that scare you, by the way?
No, because of the forthcoming explanation.
Okay. No.
Thank you.
I'm talking about from a risk of fund risk, like money fund risk, that kind of thing. Not nothing else.
No, because I guess I'll jump to point 3, which we can work backwards here. This is a new record on one hand. $7.2 trillion in money market funds is a big number, but I don't think we should look at it just in that raw statistic. We should do it as look at it on a relative basis. And so you compare the amount of money in money market funds to say like the market cap of the S&P 500. And that 7.2 trillion is about 17%, a little bit less than that of the S&P 500's market cap. If we were to look to the AAII survey recently to see how much money fund managers are allocating to cash these days, it's about 17%. To think where cash on the sidelines peaked relative to the S&P 500, you have to go back to the global financial crisis when that ratio was about 40%. So the historical average sits around 20. If anything, there's less cash on the sidelines today compared to the amount of money in equity markets than there has been at any other point in time in history on average over the, say, last 30 or 40 years. You look at the Fed ratio, which is the starting point for this whole conversation. Why are people in money market funds? Why are they looking to treasuries? We've seen over the past week or two that the earnings yield on the S&P 500 has started to tick below long-term treasury rates. The current EP is 3.53%. The forward earnings yield for the S&P 500 is 4.89%. The idea here is that in the post-World War II era, bills, bonds have returned less than stocks, but they've also had substantially less volatility. So if you can go out into the world and you can get a return on a fixed income instrument, if it's a money market fund, a T-bill, a 2-year note, and it offers a higher return than your S&P 500's earning yield, why take the additional risk? So yes, there may be a lot of money on the sidelines right now. It's not actually a ton of money on the sidelines relative to where the S&P 500 sits, given where yields are. So this is a meme. It's a fun story. People like to talk about it. It literally means absolutely nothing for the next 100 points, 500 points in the S&P 500.
Okay. Yeah, we don't talk about it.
It's one of the most popular items on Twitter right now. If you go to the For You tab and you're tapped into what's going on in FinTwit. So, when you guys hear this, do you guys just roll your eyes at it? You said you don't talk about it, but surely this is something that people have brought up to you. There's a lot of money on the sidelines, Tom and Tony. Doesn't this mean stocks are going to go up?
No, you're right about that. Or the public's underinvested. We look at this as, as Tom said, we put it in our back pocket. We don't even talk about it. It seems like such a subjective thing and such a spin on it that it means nothing to us. That's, I think, what Tom was trying to say.
If I looked at my own assets, I would say I'm very underinvested right now in stocks, but there's a reason for that, because I don't think stocks are cheap. If I thought stocks were cheap, I'd be more invested.
And I think that's what these ratios are telling us.
Long delta on stocks.
When I say I'm long delta, that's my trading account. Okay, I'm long delta. I'm long one stock, a lot of one stock. That's what makes my long delta. Mostly UNH, which is down today.
It is down 20 cents, but yet you have a positive P&L in your account. Pretty good one, too.
Yeah, but that's all because just they're finally killing premium.
Everything has a reason.
All right, what do you got? What else you got, Chris?
Well, the most important macro event this week, of course, is the Nvidia earnings report.
Yeah.
On Wednesday, there's about a $9 move when I last checked for the weekend expiration. Yep. So we're talking about 7% or so. The question is, what can Nvidia do for this market, right? I think actually the backdrop for Q1, because of all this uncertainty, has catered to the upside for companies that have been able to deliver. Going through the earnings data over the past quarter so far, we're seeing a surprising degree of leniency when companies are missing their earnings. So this is a pretty positive backdrop for Nvidia going into this report. So far this earnings season, S&P 500 constituents posting positive EPS surprises are being rewarded more than usual. From 2 days before to 2 days after their reports, these names have seen an average price gain of 2.1%, which is well above the 5-year average of 1% for similar beats. And if this figure holds, it would represent the largest post-earnings reaction to the upside since Q3 2022, when we saw a 2.4% response to positive surprises. And on the other side, negative earnings surprises are not being met with the typical level of punishment. Stocks missing on earnings in Q1 have experienced an average decline of 1.8%, which is softer, a little bit less than the 5-year average drawdown of 2.3% in this post-report window. So you're seeing a market that's more focused on upside confirmation amid this macro uncertainty right now. It's rewarding resilience while discounting the downside. I would argue that the market thinks a lot of the downside is priced in. So Nvidia coming up this week, we already have a pretty decent pop here to start things off this Tuesday. Nvidia is coming up tomorrow after the bell. If history is any sort of guide here, it looks like we could be heading for the pipeline of a positive surprise. Tony, you said something that piqued my interest, though, on First Call yesterday. What's the opportunity here when you're only looking at a $7, $9 move and an IVR of 30?
Yeah.
It's a difficult trade. It's going to be interesting, but it's a difficult trade.
Yeah, it's a difficult trade, and I think the implied volatility IV rank opens it up to, like I said last night, an extended move, either up or down, outside the expected move. So I think something like a directional diagonal spread, or a double diagonal, if you want to get more neutral, is probably the play in Nvidia from a strategic point of view, unless you have some sort of bone to pick with direction. You got June volatility at 55, that's 24 days away, and July volatility at 52. That's a 3 vol differential in your favor. I know it's an earnings play, but it is out to June and July. You usually see June and July volatility more equal, or even June lower than July. So maybe you got a little bit of an opportunity here on something diagonal. That's the way I would play it if I had to do something in Nvidia. And the IV rank is 29. It's actually coming in a little bit.
Can I tell you something about Nvidia that I see here that's weird? I've traded Nvidia now, and not great, for the last however many years, 5 years or so, pretty actively. And I don't think I've ever seen an Nvidia earnings where there is zero call skew. And in this one, there is zero call skew.
Yeah.
I don't think I've ever seen that in Nvidia. Now, what that means is that the calls and the puts are trading for the exact same price.
Equal distance away from the stock. Correct.
Yeah. If you go to just go outside the expected move, go $10 away, and the calls and the puts are exactly the same price, $10 away. Stock's 134, and you go to the 125.
The 124 is a $3 bid. The 144 are. Well, but they're 335 bid, but the stock's up 20 cents. Yeah, it's diminished.
There's nothing there. So
yeah.
So that tells me that it's the expectations are not actually as great as you might think. The other thing is, and Kai pointed this out this morning, which is really interesting, and PDD is a perfect example. The downside, the way they've annihilated the downside when companies miss, as opposed to the way that they've rewarded the upside. I mean, outside of Snow and Microsoft, there's been virtually no upside rewards, but the downside they've punished. So with no skew and the risk of, I agree with you that Nvidia is probably going to have pretty good numbers. Who knows? But
yeah,
I just can't go far enough away, in this stock right now,
to collect enough premium for what you like.
Yeah, to make it that interesting. Because if they miss by any chance, it's going to be down 20, and it's not worth it at 114. You're collecting 20 cents on the upside. If they nail it, there's not that much juice up there, up 2 times. So there's not a lot in this stock. That's all there is. That's it. Right. There's just not a lot in it.
I think this is the first time in you said it's been several years. I was trying to think of this morning. In fact, is COVID? Maybe it was COVID the last time you saw Nvidia not have this type of activity, where you look into a market where everyone's on tilt to the upside.
No. Nvidia has been in play now for years, and it's had upside skew at every single earnings until this one. I just think it's there's a couple of factors. A, it's just had a $20 run. B, it's at the top end of its range. It's already had a huge run. It's it's up a couple bucks today. It may have been played already. I'm still going to play it. Don't get me wrong. I'm just not going to play it. I'm not going to play it very big. I don't know what I'm going to do.
No, and it's. Yeah. I think the takeaway there, though, for folks is that if you've been trading Nvidia with a particular strategy that has been working the last few cycles, because you're looking at a market that look at this call skew, I'm going to sell the hell out of this. There's going to be IV crush on the other side of earnings. Even if the stock goes up, we're never going to reach these prices. Maybe go back to the drawing board here. It's a different situation.
I'm going to wait till late tomorrow because I'm thinking that it's too cheap right now. Premium's too cheap in there. So I'm going to wait till late tomorrow before I do anything.
Yeah, I think that's the right way to approach this in the short term.
Yeah, I agree with you. Mm-hmm.
Yep.
Today's just a tough day. We're getting liquidity back in the market after a holiday weekend. So
yeah. No, today's all good.
Yeah, just something of interest. This popped up a few years ago, and it was one of the reasons why people were so concerned about the economy. I don't know if there's a trade out of this, although I'm certainly looking at names like Dollar Tree and the lower end retailers. But the student loan debt payment resumption is coming around the corner, and some of the estimates that are put out over the past few days suggest consumer spending being down by $1 to $3 billion per month, which could lower GDP by 0.1 to 0.3%. That's probably going to be something that plays into big box retailers as well, like Walmart. I was talking with some of the folks on Overtime and Futures Power Hour last week about how if we're going into a world away from the tariffs, we can start to think about more of those thematic investing and trading ideas, like AI, for example. What's going on with Fannie Mae and Freddie Mac, which there's an article now on the Traders blog I'd encourage people to read. There's talk about privatizing both of those. And last week, Fannie Mae and Freddie Mac were up in the neighborhood of 50% on the back of some of this news. So there's new themes potentially emerging right now. And I think people should be willing to quickly forget about what's happened since the start of April if we're in a more normalized trading environment. And I know that's been difficult for me to do. I certainly haven't traded the equity market rebound on the upside the way that I would have preferred to. But we are probably back to a world where we can think along the lines of, how's AI doing? What's the Fed going to do? And it's storytelling time.
To be fair, there may be some truth to what stuff you just said, but to be fair, you can't trade it to be
fair on yourself. Tom's thinking, you can't beat yourself up for that.
You can't. You also can't trade things like if you think you're going to catch a macro trend trading Dollar Tree or Dollar General, you can't. You literally can't. Mm-hmm. It's not even possible. And if you think you're going to even a stock like Walmart, there's nothing. There's nothing there. You can't even be directional and be right, timing wise. Because stocks
yes, you can, Sadnaf. I beg to differ with you. Last week, I bought, before the whole tariff announcement and everything else like that, I bought my outdoor furniture from Walmart. And not only am I a great trader here on the platform, I'm also a great leisure furniture trader too, Sadnaf.
Why? Excuse me. Are they all out now?
No, but prices were going to go up because of the tariffs. I mean,
did they raise prices? Oh, I
don't know if they have or not. They may have be waiting till July 9th now to raise them again.
Well, I've got some outdoor furniture that I can sell you if you want to buy
for sale.
If you want to buy some used outdoor furniture, I'm happy to let some go.
I might want to. It's wood. I might refurbish it. Sadnaf, I like to keep everything out of the landfill. Sure, I could do that.
I'll let a little go.
Look at you, Tony.
Yep, I'll let some go. No problem.